We're seeing the second wave of COVID infections play out all around us, and it's devastating. It remains, first and foremost, a humanitarian and a health crisis. A byproduct of that, though, is what will happen to the economy. Early days yet, everyone is trying to make an assessment. But joining us to help us talk through how we should assess the impact, Sonal Varma of Nomura and Sajjid Chinoy of JP Morgan. Thank you both so much for taking the time to speak to us here on BloombergQuint. Appreciate it.
Sure thing. Good to be here.
Sonal, I'll start with you. We've all been tracking the high-frequency indices, yours as well, and they have shown a dip. So can you help us understand how representative those indices are going to be, what is happening in terms of the correlation with what's happening in the broader economy? Because I think if you unpack those indices, it still looks like much of the impact is from mobility, where the link with eventual economic outcomes may not be that clear.
That's exactly right, Ira. I think we need to sort of unpack this in multiple levels. First is what is the level of stringency that we are seeing in India. Now, we are, of course, seeing rolling lockdowns across different states. But even in states with very stringent lockdowns like Maharashtra, if you compare the level of stringency during the second wave versus the first wave, the level of stringency is much lesser. Even I'm saying in states with complete lockdown. So I think on the aggregate, while we will see rolling lockdowns across a number of states, it is very clear that the stringency is much lesser in the second wave than it was under the first wave when we had national lockdown, which shut down basically everything. The second aspect is, to what extent is this public stringency imposed alongside the fear factor amongst public, leading to a reduction in mobility. Now, there, of course, we have all the, Google, Apple mobility data, and, that clearly shows that mobility is down, 30, 40, 50, 60%, depending on, the mobility indicators that we look at. The third aspect is to what extent will this actually translate into weaker economic activity. There is, of course, some evidence we have for India. So, for instance, power demand, which was down about 30% during the first wave, is down about 10% or so far. Labor participation rate, which had dropped by nearly 8 percentage points during the first wave, has hardly declined by actually a percentage point or so far. So there hasn't actually been that much of an economic effect. Plus, there are a whole host of other indicators like railway passenger traffic, freight traffic, which again was down, multiple times in the first wave. This time is down only about 10% or so. So I think what is very clear is A, the stringency is less. B, mobility has been impacted. But C, the impact of that mobility to the real activity indicators during the second wave has been significantly lesser than what it was during the first wave. And this is, of course, also what we did see in other countries that have seen their own second waves and the third waves. And what it really does imply and indicate is that the impact is largely concentrated in the services side of the economy. The industrial side generally continues to chug along fairly fine. And therefore, I think, while we are looking at mobility indicators and that's suggesting a complete collapse, the reality is that there has been an adjustment to this new normal, and therefore the impact on real activity will be there in terms of the sequential contraction in GDP growth in the April to June quarter, but it's going to be nowhere near what it was during the first wave, and the link between mobility and activity is going to be significantly lesser this time around.
Okay. Sajjid, you in your latest report said that the impact will be heterogeneous, more asynchronous, and hopefully less enduring. Do you want to detail and just flesh out that view for us?
Well, just adding to what Sonal was saying, I think there's no question that we've become much smarter about lockdowns. They're much more decentralized. Supply chains have been kept open, and therefore the impact will not be comparable to last year. But it won't be trivial either. I think we're now beginning to see signs that this is transcending mobility into some of the hard activity data. So electricity consumption is down. We're seeing vehicle registrations are down very sharply in the month of April. As Sonal mentioned, both labor force participation is down, unemployment is high. And the worrying part here is just that this is compounding what's happened before. It comes on the back of an incomplete recovery, and I think that's the concern. Now, a couple of points I want to make. So we're working with the assumption that April and May are when you have these rolling lockdowns, and by June there is some degree of mean reversion, and that would give you a quarter-on-quarter annualized number of somewhere around 15%, of contraction of 15%. And to put this into perspective, last year, this quarter was more like minus 65. So we're working with minus 15 versus minus 65. What I want to caution everybody is this is the year and this is the season not to look at year-on-year numbers. The base effects are so favorable, they're very deceptive. If we do end up with an April to June, which is minus 15%, your year-on-year number for GDP that quarter will be plus 23. March IP, if you have 0% month on month, is going to be plus 21. And therefore, even for the full year, people talk about double-digit growth, but minus 8% this year, plus 11 or 12 next year doesn't give you much perspective. If activity was flat at this level for the rest of 21, 22, year-on-year growth for the full year will still be 10%. If you just hold activity constant at current levels. So we need to start measuring the strength of the recovery by where we are compared to the pre-pandemic level of activity. And I would argue that even before the second wave, taking into account double-digit growth for this year, we would still be 6 or 7% short. So the concern is, if you already have some sense of some scarring in that by the end of this fiscal year, you're 6% below the level of GDP that had been forecast before COVID, will the scarring compound it? I'll make one final point. I think there are two dimensions to this problem. One is the arithmetic for this quarter, but the second is to look at what does this do to uncertainty. What we find in some other countries that have experienced second and third waves is that it does linger on in terms of greater uncertainty. In India's case, by December, everybody thought COVID had gone. We were one and done. Now with the second wave, there'll always be this lingering fear for the next few months until there's a critical mass of vaccinations. Could we have another wave? And that will mean policymakers may be more risk averse to open up more slowly and shut down more quickly the next time. Labor that's gone back this time to the rural economy may be more cautious in coming back. Businesses may be more cautious in the next 6 months. So I think there's one thing to estimate this quarter, and the second is to look at what does the uncertainty do for the next 2 quarters. Is there a hysteresis impact as well before vaccinations reach some critical mass?
No, absolutely. And I'll come back to numbers, towards the end and get what you all are thinking. But Sonal, so actually that's the point. We were making calls to a bunch of small businesses, associations to try and understand what's really happening on the ground. And a few things emerged. While there is no national lockdown, people were saying that, look, there is uncertainty in terms of state level policies. In some belts, they talked about labor shortages coming in. And then the final point they made was that, look, we were sitting on orders because demand was looking good before all of this hit us. But now we don't know whether we can fulfill these orders, and we don't know, what is going to be the strength of the order flow in the next few months. So to the extent that all of those uncertainties hit businesses, whether you have a lockdown or not, there will be an impact.
Of course, Ira, I mean, there will be an impact. I don't think, one needs to assume or anybody is making the case that there is no impact. There's definitely an impact. And, as Sajjid said, there will be a sequential impact. The only point is that, when we look at very high frequency indicators, as you had asked earlier, that is not indicative of the extent of economic hit that we are going to see. I think also it's quite important to think through what happens going forward. Now, as we are seeing the rolling lockdowns across states, and we are starting to see some plateauing in cases in Maharashtra, and as other states and people do behave more cautiously, there should be some further flattening out of the aggregate curve sometime in May. I think once we do actually see a peak in daily cases, the question is, how should public authorities respond? And, one key lesson really from the first wave and having combated the virus during the first wave is that you don't need to open up all the sectors of the economy. I mean, there are particular sectors, particularly the contact intensive services, which are more susceptible to virus transmission. So you don't need to lock down an entire industrial sector in a particular state that can continue to run. But the segments that are sort of drivers of, sort of super spreader sectors, so to speak, there needs to be some stringency that has to be maintained in those sectors until we accelerate the vaccination process. So I think, while the reduction in activity this time around will be there, it is going to be much lesser than what it was in the first wave. Similarly, when we come out of this second wave, we cannot see, a complete opening up and a V-shaped recovery, because we have to allow specific sectors to open up and go back to normal, not everything to immediately go back to normal in terms of lockdown stringency. And importantly, from a medium-term perspective, the key solution really is to accelerate vaccinations, which clearly is going to be key to how quickly we can open up the contact-intensive services sectors. I think, it does look like a challenging quarter, and, the experience from other countries is there will be third wave, there could be fourth waves until vaccination truly comes in. But as things stand, I think looking at where the, trend is for India's growth, I think the trend is still headed higher in terms of the business cycle. And I think the big picture view is still that this is going to be a bump for 2 months, maybe 3 months, but nothing that really derails the business cycle that is starting.
And I'll come to the vaccine policy in a minute. But Sajjid, you broadly agree with what Sonal is saying. I do want to ask, though, so specifically, for instance, contact-intensive services. I know there may not be a large contributor to GDP, but there are large employment sectors, some of these sectors. And given the experience of the second wave, if policymakers are more cautious about opening up, do we continue to see, maybe, as you said, sort of heterogeneous impact, not just across states, but even across parts of the and segments of the economy?
Absolutely right. And that's the hysteresis I was referring to, that having learned from this, we'll be much more cautious over the next 6 months in terms of opening up. And if there are certain districts or states that see another surge, they'll be very quick to close down. That's been the experience around the world. So I think we learn from this. I don't disagree with Sonal at all that, 2 quarters from here, 3 quarters from now, there are many tailwinds or some tailwinds. The most important, of course, is getting jabs in arms. Doing that vaccination is the best stimulus, I think, this year. Secondly, we've got a lot of capital expenditure that both the center and the states have planned to do in their budgets, 30% growth in capex. And we're seeing a booming economy. So there are things to look forward to 2 quarters down, but we have to find a way to get through the next 6 months. I'm not for a moment suggesting we should not shut down. The overarching priority should be to do what's needed to save lives. The economic fallout is what it is. We should use policy and fiscal policy to offset that. I'll just make one final point. Given that this is so heterogeneous, what should the policy response be this time around? Last time, because we had a national lockdown, it made a lot of sense to do central fiscal, central monetary. When you have a monetary union and you have such an asymmetric shock, that Chhattisgarh mobility is down 65%, Madhya Pradesh 45%, Tamil Nadu 5%. A state-specific relief seems to be the optimal response. And we've begun to see that Maharashtra and Delhi have announced cash transfer. So I think the response in the next 2 months needs to be, how do you impart relief urgently, both in cash and kind, both for a safety net, but also to prevent the reverse migration. And I think that has to be the focus at a state-specific level, backstopped by the center. I think the center's role is to provide the free grain which they have, increase NREGA allocation, so when NREGA demand picks up, they can accommodate that. And once we get through that, then I think the importance of budget execution just became even more so after the second wave.
But as you said, vaccine is the first response. So, Sonal, I mean, I know you all are economists, but, the numbers in terms of how quickly you can vaccinate a large share of the population are important from an economic perspective, obviously. There has been this side debate on pricing, on who bears the cost. How do you see this debate in the context of what is important, which is to, get people vaccinated as quickly as possible?
At this stage, it's more about how quickly the supply response can now come in with the various policy changes that have been made with respect to pricing and, how quickly foreign vaccine makers can come in and multiple others, including credit, etc. I think the question is, who's lined up and how soon can doses come in. As things stand right now, we are actually in a vacuum, so to speak, because domestically it is still the two companies, Serum and Bharat Biotech, which together have a 75 million dose monthly capacity that's available. And I think while we have opened up for 18 plus, there is a significant demand supply shortage, and this shortage will continue until the end of May. I think things should start looking much better after June. Sputnik, which is going to be a combination of imports initially and domestic production, that's estimated to be about 850 million doses annually. We have a couple of others lined up in terms of Zydus Cadila and the Johnson & Johnson, which is likely to start production from August. We have Bharat Biotech's intranasal that's going to start potentially from October, Pfizer, which may come in. So I think if you look at those candidates, and I think there'll be more with the vaccine policy changes, the 75 million doses availability per month right now can easily go in excess of 250 million doses, as by the third quarter and thereafter. So I think the supply shortage is clearly a big challenge in the next 2 months. But post-June, our view is the inoculation rate should significantly pick up from the 2.5 million doses per day daily that we are seeing right now to in excess of initially 5, and then I think potentially even above 8 million or so. What does that imply? I mean, it implies that, as compared to slightly over 10% of the population which has received, those in total, this number in our view can overall go to somewhere around 45%, maybe even higher by the end of this year. So that, along with, the number of people who are exposed plus, infected, so the ones with antibodies, together would suggest that by the end of this year, India should have herd immunity. And this is quite important, Ira, because we will keep seeing multiple waves. It's important that we keep the fatality rate low. And if we can achieve that with vaccination rates, I think, after, around third quarter this calendar year and beyond, the ability for the economy to handle hopefully should be much, much better.
Sajjid, I know side debate, but still, what's the optimal sort of division of both cost and responsibility between the two arms of the government, the center and the state? I know you had something to say on that.
Well, just either that I think right now the binding constraint is supply. So that debate's a secondary debate. We have to boost, augment supply in the near term, domestic and imported, exactly as Sonal said. I think the design principle is the following, that how do you augment supply, but at the same time, use the private sector's energy, distribution networks, entrepreneurship to hasten the pace of vaccination. We need in India the private sector to augment the public sector. You see, in many other countries like Brazil and South Africa, where this is given out completely free, it's only available at public health centers. India is too large and heterogeneous for that to happen. So we need the private sector to be involved. And at the same time, how do you ensure that for all the deserving parts of the population, this is free, given the large positive externalities? And I think that's the tension here, that on the one hand, you want the private sector to be involved in distribution rapidly, get jabs in arms quickly with the help of the private sector. And at the same time, you want to ensure that you're subsidizing large parts of the population. And so where I've come out is, vaccine vouchers is one way, but there are other models. But I think that's the fundamental tension. The objective here has to be whoever bears the cost, get this done as soon as possible. And in terms of cost, the total fiscal deficit that's budgeted this year is upwards of 10% of GDP. 0.5% of GDP in vaccination costs is not going to break anybody's budget, whether it's the center, whether it's the states, however it's divided. So I think cost should not be a constraint. I'll just make one point, though, which is less appreciated. In the last 4 months, states have borrowed almost 100,000 crore less than they had planned to. So we're going to enter this year with the recognition that actually state fiscal deficits are lower than what the RE number suggested. Right, their cash balances are higher, which is why they've hardly borrowed in April. But of course, the upshot of that is that their fiscal impulse last year was even lower. So I think the policy has to be, if states have to borrow more, the center has to borrow more for relief or for vaccinations, that's just fine. And 0.5% of GDP doesn't move the needle. And states may actually have more fiscal space than this year to accommodate revenue shortages and provide relief than I think markets anticipate, given where last year ended.
2 points. Sonal, firstly, I'm sure you agree, and it's been a little confounding why we are so focused on this sort of cost, because the costs are bearable, as Sajjid said, both at the central level, even if they have to take the entire cost on them, or the center plus state level. So I'm sure you agree that's not a binding constraint. But in terms of just the capacity right now for individual states. Let me frame this question correctly. My question is that if they are spending more towards the health expenses, will they cut back on other, planned capital expenses as we've seen in the past? And that too has a bearing on sort of the economy and the ability of it to rebound.
Yeah, I think that potentially is a risk because clearly, unlike the center, there are greater fiscal constraints on states and how much they are allowed to borrow, even with the leeway that they have been given. And therefore, in the context of the additional health cost that will fall on them, I think at the margin there is surely a risk that states end up pruning some of the capital expenditure.
Sajjid, you disagree on this, right? My point here was that, look, we know what states do. They try to meet those fiscal deficit numbers by cutting expenditure. They've done that for years, and I think RBI's reports have shown that. Won't they keep doing that if we keep adding overheads on them?
Well, it's very suboptimal because it'll make fiscal policy pro-cyclical like it happened for the first 6 months of last year. But which is why I think the center should remind the states that even if you look at the budgeted numbers for this year, look at the top 17 states, the budgeted fiscal deficit for this year by states is 3.3% of GDP. Whereas under the roadmap, they're allowed to go to 4%. Yeah. Number one. And number two, they're entering this year with large cash balances, which is why they've hardly borrowed in the month of April. So I think it'll be very suboptimal for the states to keep to these deficit levels, right, and cut expenditures and cannibalize capital expenditure if you've got higher health or more vaccination costs, which is why I think the center should urge states that, go all the way to 4% if you have to, from 3.3. And just because you've got cash balances sitting, don't cut borrowing this year. Borrow and spend that. As I said, a key driver to a better medium-term outlook is for that 30% capital expenditure, both at the center and state level, to actually be executed. Much of the labor market scarring that we refer to is contingent on that infrastructure spending happening and jobs being created as a consequence.
At the central level, Sonal, at most you would think that things like food transfers, which they've already announced an extended program, perhaps some cash transfers if this becomes a nationwide issue, that's the extent of the policy response we're talking about right now?
I would think so. I think, like you said, I mean, first of all, it's largely state as the first line of defense in terms of, giving financial support to the vulnerable. At the center level, yes, more of food transfer to the extent that we've seen labor migration and greater demand for rural employment guarantee program, allocations there will go up. The center itself will face some revenue constraint because we have seen GST e-way bills drop nearly 30% or so from last month's level. So there will be some hit on the revenue side. But nevertheless, I think this is the time for the center side to really step up. Beyond that, I think the big challenge really is for the small and medium enterprises and particularly in the services side of the economy, because even when the second wave subsides, some of these segments may not be allowed to operate at 100% capacity. And therefore, extending more credit guarantee support for those specific affected sectors, I think will become a lot more crucial.
Sajjid, same question to you, but also added here in terms of the fiscal outcomes at the center. Is there reason to worry about those already in terms of tax revenues, divestment, etc.?
I think it's too early. We saw last year how revenue surprised so sharply in the second half of the year. But I think budget execution becomes crucial. And by that, I mean, we really need to make sure that those asset sale targets are met. Right? That is the linchpin on the revenue front this year. So I just hope that execution happens early and aggressively this year, and we can get those disinvestment targets. Similarly, at the center, I would agree that apart from the relief being provided through higher NREGA or higher food support, that capital expenditure is really crucial. I know I sound like a broken record, but that for me is the key driver of growth in the next 3 or 4 quarters, apart from the global support you get. I think the last thing the center can do is if there are certain states who are already stretched fiscally, who need to borrow more and cross that 4% level, either for vaccination or for relief or even for capex, it should be allowed. Given these exceptional circumstances, states should have the latitude to borrow more. We don't want fiscal policy becoming pro-cyclical in the sense that we're cutting expenditure, in the aftermath of a second wave.
Sajjid, just a small counterpoint there. So, I mean, all that infra spending that was spoken about now, with health risks rising again, does some of that get pushed back? I mean, they may have the capacity to get the monetary capacity to push those, but physically it may not be possible.
And that's possible. That's very likely. What I mean is, if that gets pushed out by 1 quarter or 4 or 5 months, it's fine. But we should not say that we're going to cut our infrastructure plans over the next 4 quarters because we've got these new liabilities that we have to incur. I think that would not be optimal. So if it gets pushed by a quarter, it's perfectly understandable. I think all of this is going to get pushed by a quarter, including monetary policy normalization.
Okay, I was coming to that. So, Sonal, what's the role of monetary policy here, apart from perhaps pushing back normalization a little bit, keeping liquidity as comfortable as it has been, supporting, government borrowing if required, state borrowing at some level?
All of that, and as Sajjid said, the normalization process gets pushed out by a quarter. And I think, sort of the credit-related support measures is quite essential. RBI seems to be quite focused on bond yields and to ensure that, financial conditions do not tighten too quickly. I actually think there are a couple of challenges that monetary authorities, will face going forward. First is that the inflationary effect of the shock. Now, of course, the supply chain disruptions are not as severe as it was during the first wave. Nevertheless, we have seen food price build-up again happen in the month of April, and it is quite significant, although the year-over-year rates will come down. So the supply side inflation is sort of picking up again. And second, this is happening in the backdrop where global growth is actually doing better. So you do have global commodity prices rising, and we've seen firms actually state that rising raw material costs are starting to squeeze on their margins. So while there is an adverse impact on growth, there is also an adverse impact in terms of inflation. And navigating that becomes quite challenging because we are already sitting at 3.35 on the reverse repo rate. So just the effective policy rate right now. So I think, status quo really is the name of the game. The second challenge, I think, from a 6 to 12 month perspective is going to be how US monetary policy moves. Because if the Fed, and our view is, Fed is going to signal taper sometime in the second half of this year and begin tapering early 2022. Then from an emerging market standpoint, global financial conditions could end up tightening much faster than domestic conditions would warrant. So I think that's going to become also a challenge from the RBI's perspective.
Sajjid?
Well, so I agree with Sonal that the good news is that I think we're being much smarter about the lockdowns, and I think policymakers are being extra careful to make sure supply chains are not disrupted. And there's no evidence, at least in the food price data for April, that there have been any supply chain disruptions. That's the good news. I think what we need to watch out for is there have been so much cost rationalization by firms in the last year. Right? And I think we referred to this, that nominal GDP in the first 9 months of last year contracted at 7%. Listed company profits have grown in double digits. Part of that is cost rationalization. Now, having done that, if you do get raw material or input price pressures, firms might be more likely to pass those on in this particular cycle. So I think we need to be wary of that risk. Now, just as I spoke about the favorable base effects for growth, there are huge favorable base effects for inflation. Between April and December, inflation last year was 7%. So for the next 6 months, ostensibly, there's going to be no inflation. Inflation is going to gap down to the 4% handle, and there'll be no visible pressure. But of course, our job's going to have to be to look at the underlying momentum. The fact is core inflation has been 5.5% for much of last year. So I understand that given this new uncertainty, the central bank will wait it out and assess this. But I agree with Sonal that 2-3 quarters down the line, monetary conditions are already ultra accommodative. And I think what we want to do is normalize as soon as we can. Having negative real policy rates for long periods of time, invites risks and challenges down the line, whether inflation or financial stability. So once the second wave is over, I think we need to get to a path where in the RBI's Taylor rule, the weights begin to rebalance away from the output gap and towards the inflation gap.
A quick last couple of questions on how sort of financial markets have been responding. Sajjid, I'll stay with you. So I think one perhaps consequence of this second wave has been that the bond markets have calmed down because they pushed out normalization. There is some concern on the currency front though, because I don't know what capital flows will look like. I'm not sure how the import-export balance will adjust to this second wave. Is there reason to focus on BOP more than we have?
I think there's no reason to worry, but there are important differences from last year. Last year, you had a basic balance, which is your current account plus your FDI, about $75 billion. So your basic balance every month was about $6.5 billion. And you had this huge BOP surplus. So there was never a chance for any month to have a BOP deficit. And that meant sustained one-way rupee appreciation pressure. And I think the RBI did very well to buy all those dollars. The last thing we want is tighter monetary conditions through a strengthening rupee. But what that also did was invite this carry trade, and that put further pressure. Now, what you're seeing is because of the second wave, some of that carry trade is unwinding, and I think two-sided volatility of the rupee is actually healthy for the market. This year, the difference is going to be that if your current account's a deficit of about 20 or 25 billion, even if FDI flows are 45 billion, your basic balance is 20 billion, not 75 billion like last year. That means about 1.5 to 2 billion a month. So there will be certain months in which if there are capital outflows, your BOP will turn negative like we're seeing, and the rupee could move in both directions. That will be healthy, I think. I think we should not worry because the RBI has got a war chest of reserves. One last point I'll make is to the extent that the RBI is selling dollars and soaking up rupee liquidity, that actually alleviates the trilemma because this way they can sterilize some of the GSAP operations by selling dollars and absorbing that rupee liquidity.
Got it. Last word from both of you. Sonal, sort of circling back to where we started, numbers that you're watching, data points that you think have to be closely watched to ensure that any red flags are dealt with from a policy perspective very, very quickly. And if you have, a sense of what we should be expecting, at least in the April to June quarter, year-on-year growth or sequential growth, that will be useful.
Sure. I mean, Neera, I think right now all eyes on, whether we're able to flatten the curve because ultimately the path of the virus is going to determine the path of the economy. And that's the reality. I think, our baseline assumption is the virus peaks out in May and then it sort of gradually tapers down. So we are seeing this more as maybe a 2-month big hit, but June onwards, incrementally gradual improvement in activity. If that plays out, then on a sequential quarter-on-quarter basis, we are currently looking at a contraction of about 1.5%. This is not annualized, which implies a year-over-year rate, which will still be pretty robust, 25% or so on a year-over-year basis. We've cut our growth estimate by about a percentage points for the full financial year FY22. We are at slightly above 12%. I think given the way lockdowns are getting extended, there's clearly downside risk to this number.
Sajjid, same question to you. What are your numbers looking like right now?
I think the most important number this year is going to be number of vaccinations per day. Yes. More important than any economic number. Right, so of course we want to monitor the virus, but we really have to boost the vaccinations. We've seen around the world through sheer vaccinations what the UK has done, what Israel have done, what the US has done. So for me, that's the single most important number. As I said, this is the year to ignore year-on-year numbers, whether they're inflation, IP, GDP. We're working with a sequential contraction of about 15% April to June. That sounds worse than it is. Last year, this time was about 65%, so this is much less. I'll just end with this point that, economies are very non-linear. If this is a 6-week shutdown, it's April and some part of May, we may be able to bounce back quite soon. If this extends into June and July, then the outcomes, on activity, on the labor market, on the fiscal, become a little bit more challenging.
All right, that's a good point to end on. Thank you both so much for taking the time to help us talk through how this is all going to play out for the economy. And thanks for watching Bloomberg.
Pleasure.